All right, General Electric's new CEO, John Flannery, is expected to lay out a roadmap for the company's road to recovery. Investors also want to know if the company will cut its dividend, an old reliable dividend. Sean O'Hara, president at Pacer ETFs, joins us now to discuss. All right, Sean, what do you expect GE to do today?
Well, I mean, first off, it's an amazing thing, the change in leadership in the market. If you go back 5 or 10 or 15 years ago, GE was having the problems that they're having. It would be catastrophic for the broader-based indexes. We don't own GE in our cash cow series of ETFs because they don't generate enough free cash flow. And I was looking at the numbers this morning. They have a $177 billion market cap, $130-some billion worth of debt. So that makes it, enterprise value of 300. And then you start to run the numbers through the formula, like if you were doing your household accounting.
Yeah.
And, they're under a lot of pressure. They don't generate a lot of cash. And so sometimes when a company gets in this position, maybe the right thing to do would be to cut the dividend, regroup, focus on their 3 core businesses, as I said, aviation, power, and healthcare, and see if they can't turn things around and increase the cash flow and come back to the dividend.
All right,
the dividend right now is, by the way, it's almost a 5% dividend because the stock has come down so much.
And it's been reliable for so many investors who are dealing with the fact that while the Dow Jones is up almost 30% since the election, GE has lost almost a third of its value. So it's struggling, but you count on that dividend. So in a way, you say, all right, we won't worry about how the company's doing. Anyway, the new CEO, Mr. Flannery, on the job for 3 months now, and the Wall Street Journal is reporting that they're going to focus on, and you brought this up, healthcare, power, and aviation.
Yes.
If that's the focus, are they going to get out of their other businesses?
Well, I think they'll probably try to sell some of those things. GE became very scattered in terms of the businesses that they were in. They became one of these giant conglomerates. And perhaps a little focus and a little, kind of bringing things together and really getting rid of the things that are a distraction or not in growth markets or that don't generate enough cash. Jack Welch used to be tyrannical about the way he ran GE. If you weren't in, if you were in the bottom 10% of employees, he would get rid of you. If you had a business and you didn't hit your numbers, you were gone. Maybe a little of that would be a good thing for GE today.
Well, they employ about 300,000 workers. Do we expect any job cuts to be announced?
I think, when they're where they are, everything's on the table.
Yeah, unfortunately. Deirdre Bolton is going to be following that story for us today. I do want to ask you about stocks overall. What sectors do you like right now?
Well, we like, in the free cash flow models that we run, we like healthcare, telecom, and technology. For dividend investors, most of the dividend investors choose utilities and consumer staples because they've been reliable. But what we've seen with some of our free cash flow screens and our cash cows ETFs is that you can diversify your dividend away from those sectors that are not traditional growth sectors.
Right.
Surprisingly enough, in today's market, you can actually get very, very competitive and very attractive dividend yields from technology, which wouldn't have been the case, say, 15 or 20 years ago.
All right. Sean, thank you so much for your perspective this morning. Have a great day.
Thank you too, Lauren.